Hello, my name is Godwin and I'm from Lutalo. I'm here today to try to calculate a question concerning IAS1. Last time we looked at what IAS1 means, and among which IAS1 we now know the full definition or the full of the initials of what IAS. We all know what IAS means, and simply IAS means the International Accounting Standards. Now, when these standards are very many. Today I want us to look at International Accounting Standard 1. The International Accounting Standard, it tries to give us a sense of direction on how to present the various statements of finance or the financial statements. We well know that the financial statements that we majorly talk about here we have the financial statements. These financial statements here, the financial statements that we are going to look at here, we are going to have the income statement, we are going to look at the statement of financial position, we shall look at the statement of change in equity, and finally we shall look at the statement of cash flow. Under IAS1, we are going to look at the income statement, we shall look at the statement of financial position, and we shall also look at the statement of change in equity. Among the statements I've listed here, I've listed 4, but I'm saying we are going to look at 3. Why? Under IAS1 tries to give us the presentation. It tries to show us how best we can present these 3 statements to the public. Remember, in our background, or the background of accounting, we saw the users of accounting, the users of this information, the accounting information. One of them, we said the public, we said the government, we said the directors, the employers, and the other stakeholders. So these stakeholders, there is a way we have to present to them these statements. And the standards have a presentation, how these statements are to be or are supposed to be presented to the public or to the stakeholders. Among which we are going to look at today is the income statement. Here in the statement of cash flow, we shall look at it under IAS7. IAS7 is where we shall see the statement of cash flow. But today I want to take you through the income statement as per accounting standard, that is IAS1. So how is the income statement presented? How should it be presented as per the standard? Remember that the IAS1 standard, it is based on what we call the accrual basis, the going concern, and the fair. How this we shall relate to them, and we'll see how we work. So we are going to see how presentation of the income statement, or we can call it the profit, loss, and other comprehensive income of that presentation of the income statement. Here is how we are supposed to present the statement, the income statement. We should present this statement in this format. One, we should have the revenue coming first. The revenue arises from what we are calling the sale. The revenue, we are saying the revenue comes from what we are calling the sales. From the sales, we may have some returns. The sales that we sold some commodities to, let's say, client, then that client finds some default in those commodities and returns back some. So, on the sales that we made, we shall less the returns inwards. So under revenue, we shall have the sales and we less the what? Returns inwards. That is under what? Sales. Or that is under revenue. We all know the definition of revenue. I won't go through that because we covered it in the previous lessons. So after the revenue, we have to look at the costs. What costs did we incur, or what costs did we incur to make this revenue? That is what we call the costs of sales. So we shall look at now, after the revenue, we go on the costs of what? Sales. Under cost of sales, we are having the inventory. The inventory that was in the organization before or was in the organization as at the beginning of this or of that period. That is the opening inventory. Opening inventory. Then we shall add purchases. We add purchases. Now remember, whenever you purchase, in some cases, you are not given what we call the after-sales services. Now, if you are not given that after-sales services, such as transportation costs, then it implies you have to incur that cost to transport those purchases you have brought from the point where you bought them to your warehouse or to your workstation. So those costs that you are incurring there are what we are calling the carriage inwards. So we also add carriage inwards. Then we less the closing inventory. Why are we lessing the closing inventory? It is self-explanatory. We are lessing the closing inventory simply because it has not yet raised any revenue. It is still in our what? In our store, meaning it didn't bring us any revenue. So that's why we are lessing it off from these areas. Are we together? In case of a purchase, and that purchase you are given a discount, I will add the discount received at this point. I less the discount received at this point. Altogether. That is all under costs of sales. After the cost of sales, I will now go on. When I subtract cost of sales, the total cost of sales from the revenue, I will get what we are calling the what? The gross profit. This is the profit that the organization has earned after lessing the cost of sales from the revenue. After getting the gross profit, we want to know what exactly did how much profits did the organization get out of this revenue. So we also less operating expenses. Now, back in the financial statements that we used to make, we were putting all the expenses down here. But this time, these expenses are categorized in three. The three categories of these expenses shall have the selling and distribution. The selling and distribution costs. We shall have the administration costs. And we shall have what we are calling the finance costs. Are we together? So, remember I got the gross profits. After getting the gross profit, I less the operating expenses. Now the profit we get when I subtract the operating expenses from the gross profit, I am getting what we are calling the profit before what? Before tax. I get the profit before what? Before tax. When I now less the tax that I incurred for that period, I now get profit after what? I get now profit after tax. So this is how I expect you to present that statement, or the income statement, or the statement of profit, loss, and other comprehensive income. First of all, we shall have the title, and that title should include the date, the name of the organization, and it should also have the type of statement that you are working out. Here are the basic components of this statement of financial position as per IAS1. We said the first thing we shall have the revenue. We shall have, let's put here details. We can put here note. And we shall put here amount. I expect you to have revenue coming at the forefront. And you should tell us, you should show the examiner where the revenue is coming from. You can call it a note. Which note was that? Where all the working? It can be a working, it can be a note. Working one, and put here its value. Then we less the costs of what? We less cost of sales. We only bring here the totals. Mark me well, we bring here the totals of these figures. We don't want to see the costs of sales in bits. We only want to bring here the final figure of the cost of sales. We shall less the cost of sales, the total cost of sales. When we less the total cost of sales, we said we get what we call what? Gross profits. We get gross profit. And after obtaining our gross profit, we less operating costs or operating expenses. Now here we will not bring the operating expenses as one figure. No, we only bring the total selling costs, selling and distribution, costs, bring it here. Remember, then we also less the administration costs, less it, and we also less the financial costs. Now someone is there wondering where we know how financial costs are incurred. Now a financial cost is that cost that is incurred on financing a business. For instance, if I go in the bank and I obtain a loan, that loan I have to pay an interest on it, isn't it? Now that interest that I pay on top of the loan is what we are bringing here as a what? A finance cost. It can be a bond, anything. It will be a financing cost. That is where I have to subdivide the cost. I have to subdivide to show which department takes up more more expenses than the other. So when I less the operating costs from the gross profit, I will get what we are calling the profit before tax. So this is our profit before tax. So after obtaining the profit before tax, I now bring in the tax component at this point. I tax this profit because we well know that any business is taxed. It is not taxed on the revenue, but it is taxed on the profits that made. Are we together? It is taxed on the profits made. So here I'm giving the tax unless tax. And the tax, I bring it, they give you a percentage. So when I less the tax, I now get what we call the profits after what? After tax. And this is our final destination. This is our final destination of the income statement. I want us to look at an example, at a live example of how to make an income statement as per IAS1. And straight, we are going to look at an example in our handout. That is illustration 5. That is on page 61 of our handout, which says the following trial balance of Zipper Limited as at 30th June 2012. Hopefully we all have the handout, and I will not go through what we are having because I assume everyone is holding his or her handout, following together with this video. This is how we are going to make it. I am going to give you the simplest format of how to work this out. Yeah, we are going to try this number of Zipper. So first of all, before you go directly to the income statement, there are some things that you first have to work out before you take directly to the income statement. Because we have seen we take only the totals in the income statement as per standard of IAS1 presentation. Therefore, I'm going to give you a schedule that you should use, and I know you will love it. Trust me. Make sure you follow with me step by step, and we shall see ourselves at the top. So we are going to have Zipper. Sorry, I know I have to look to the question so as not to go astray from it. So we're having Zipper. Zipper Limited is working. I will call it the working schedule. I will call it a working schedule. I will call it a working schedule. Now, under this working schedule, this is what I expect of you. First of all, we shall have columns. I can have columns like these ones. I've told you the simplest method is this one I'm giving you. It is the simplest, and I am assuring you, you will love it. You will love it. Just know you will love it. So this is 1, 2, 3, 4. I think I should add one other one. How can I make it? How can I make it? I'm just subliming first trouble for this line, and I extend it this way, like this. Don't mind on the chalkboard, just mind of the matter that we are getting. Because this period, we should try and do. That is what the president told us. That is what the minister told us. The minister who is concerned with our education. So please, let's do it like this. So here, we shall have our revenue. Let's have our revenue there. Let's have the cost of sales here. Costs of sales. Here we are going to have the selling and distribution cost. Here we shall have the administration costs, and here we are having the finance costs. Remember, in accounting we have to show the degree to which our figures are. Since in the example we are given in shillings, first of all, we put the unit, that is shillings, and we give the degree in which our figures have been removed. That is 3 zeros, shillings, 3 zeros, shillings, 3 zeros, shillings, 3 zeros, shillings, 3 zeros. Which again? Now, as per our question, we go what has been given at what by what has been given. So we begin with, first of all, they have given us inventory as 30th June 2011. So that inventory is what we are beginning with. So we shall have our opening what? Opening inventory. Where does our opening inventory fall? It will fall under cost of sales, isn't it? It falls under cost of sales. I remember when we are working it, when I was showing out the presentation, I tried to show you where each falls. So the inventory, we are going to put it under cost of sales. And our inventory, we are having 3,038. We're having 38 to what? 295. That is our inventory. Then we go to receivables. Receivables are not required in the income statement. Payables are also not required in the income statement. We have 10% bond interest. 10% bond, that one is a bond that needs, it is like a loan. We know a bond, what a bond is. So we have bond redemption reserve, like that. We have general reserve, retained profit. They are all not required in the income statement. We go straight to the bond interest. Now, bond interest is here how we are working it out. Bond interest. Now, the bond interest that is put there is the one that was paid for that period. So we have bond interest paid. Bond interest paid. What was the bond interest paid? The bond interest paid here, we are seeing 1,000. 1,000. So we are putting it here. It is a finance cost. It's going under finance cost. 1,000. But the bond that was taken from the bond that was taken was worth 20,000. Now we are seeing here bond interest paid of 1,000. But in the handout we are seeing that it was that bond had an interest of 10%. Given the fact that the bond is 20,000. The bond is 20,000. And they are saying this bond has to accrue an interest of what? Of 10%. So 10% of this bond is what has to be taken to the financial, to this schedule. But on the bond interest that was paid, they paid 1,000. So what was supposed to be taken in here was the 10% of 20,000, that is 10 over 100 times 20,000, I get 2,000, isn't it? That is what I get. But here I'm seeing we only pay 1,000. Meaning there is a balance that is remaining of how much? 1,000. That is what we are calling bond accrual. So we are going to add bond accrual. So we add bond accrual. What is that accrual? Is 1,000. That is the bond that is not the interest, the bond interest that is not yet what? That is not yet paid. Are we together? Then we have interest of, so we have equipment at cost that is not required. Here we have motor vehicle at cost, it is also not required. I'm seeing bank is not required, cash is not required. Sales, yes, we have sales. Where do we place sales? Sales come, I told you sales brings in revenue. Meaning it is going to fall under the revenue what? Column. So that is how much sales do we have? We have 99,500. Sales are having 99,500. Those were our sales. Then we are having purchases. Where are the purchases going? I told you they will go under cost of what? Sales. So I have add purchases. I add purchases. They are going under cost of sales, and our purchases amounted to 66,350. 66,350. Those are our purchases. Then, after the purchases, we have sales returns. Sales returns. I remember talking about it. Sales returns is the same as returns inwards. So we less sales returns. Where are they going to be placed? They are affecting which column? They are affecting the revenue column because they are returns on what was sold. So how much was it? Sales returns, we are having 1,150. Hopefully we are going together. I'm not misleading you. We are having 1,111. It is 1,150. Hopefully you're seeing it. 1,150. Yes, it is 1,150. Then we have carriage inwards. Carriage inwards. Carriage. Now carriage inwards, these are the costs. I mentioned it before. These are the costs that you incur when you purchase, isn't it? When you purchase something and you need to transport that something from where you have purchased it from to your workstation, those costs are what we are calling the carriage inwards. So we add them onto the costs of sales because there are also costs that incur in purchasing. So they increase our what? Buying price, in other words. So that the carriage inwards, I'm having 240. Hopefully you're also having 240. So I have added on the cost of what? Cost of sales, that is to what? 240. Then I have wages and salaries. Wages and salaries. Wages and salaries. Wages and salaries I'm having a figure of 10,360. 10,360. Wages and salaries. We are going to put them under the selling and distribution costs. We are going to put them under the selling and distribution costs, that is selling and wages and salaries. It is 10 through what? 10,360. 10,360. Then, when you go in the additional information, when I look in the additional information, I'm seeing prepaid salaries. Prepaid salaries. When you hear about prepaid, prepaid simply means you paid something up front. For instance, whenever you buy airtime on your phones, that is a prepaid, that is a prepayment. You are buying airtime and you are not paying for the costs at the back. You are paying for costs in front that you have not used. That is what we are calling a prepayment. So the prepayments, we less them off. So we less prepaid salaries. Prepaid salaries of how much? I'm seeing of 500, no sorry, prepaid salaries of 700,000. That is salaries, that is 700. I'm seeing rent, rates and insurance. Rate and insurance. Rent, rates and insurance. Now the rate and insurance, they are going to go under the administration costs, and we are seeing a figure of 5170. 5170. 517. Those were our what? Rent, rates, and insurance. And we are saying that rent had an accrued. When you go in the additional information, they are saying that accrued rent shillings 500,000. So this is rent that was consumed and was not paid. In other words, so that is, we are going to add that rent. Accruals we add. So we are adding accrued rent of how much? Of 500,000. Add accrued rent of how much? 500. Of how much? 500. Then we are having sales discount. Sales discount. Allow me to wrap off this and I continue with this side. We are having a sales what? A sales discount. So remember, we are having how many columns? Have that of revenue. We have that of cost of sales, selling and distribution. We have that for administration, and we have one for what? Finance costs. So we are having sales discount. So remember, this is revenue. We have cost of what? Of sales. We have distribution costs, and we have the finance costs. Those are the costs that we are having. Therefore, we have seen that, they have told us we are on which part? We are on the sales discount. Sales what? Sales discount. Now this sales discount arises due to what? Selling and distribution. So they are going to fall under here. So we add them there. That is how much? 1246. 1246. Then we have directors. Do we have any prepayment there? Then we go to directors. We are saying directors remuneration. Directors remuneration of how much? Of 2,500. That will go under what? Oh, missed something. Missed the administration cost something. So this is administration. Admin costs, and these are finance costs. So under we are saying directors remuneration of shillings 2,500. They will go under finance, under administration cost. That is how much? 2,500. Hopefully we are following together. But when you go in the additional information, we are seeing that the under part C, we are seeing accrued rent of shillings that and directors remuneration of shillings 2,000. So we are going to add accrued directors what? Remuneration of how much? 2,000. Are we together? We also add it there. Then after that, we are going to go straight to what we are calling the closing inventory. We less the closing inventory. Less closing inventory. Where does the closing inventory affect the cost of what? The cost of sales, and there we are having 49371. Then after we are having the depreciation. When you look in the additional information, that is part E. Depreciation, they are saying depreciation on cost. That is equipment, 10%. That is 10%, 10 out of 100 times what was the cost of the equipment? 35,000 times 35,000. Depreciation will also go under administration cost. That is 3,500. Then we have motor vehicle. And we are having motor vehicle, it was at 25%. That is 25 out of 100 times what was its cost? Its cost was 28,500. 28,500. And when you place your calculator, we are seeing the depreciation of 7125. 7125. I think you are following together with me. Now from there, after doing this, we now add, we go on adding all the totals in each column. So when I add now, I'm adding 99, when I add 99, 500 plus 1150, plus 1150, no, is it? No, this is a less. Sorry, this was a less. 99, 500, when I less 1150, I put here its total. So I put the totals here. So I put the totals there. When I add, when I get 99,500 minus 1150, I automatically get 98. I get 98,350. 98,350. Are we together? I get 98,350. And so when I add all these costs, the cost of sales, that is 38,295, I add the purchases, that is 66,350. Then I add, what was this? I add the carriage inwards, that is 240. And also when I add the 49, 49,371, I will automatically get 10,906. 10,090. Hopefully you are pressing your calculators. You are pressing your calculators. That is the answer we are getting. 10,09006. Are we together? That is when I add. No, I've put it in the wrong column. Sorry. It's supposed to be here. 10,09006. When I add this plus this plus this, then I subtract this. I have to get this. Then after, I also add the administration cost, and I'm having 2795. 2795. I also add this is for administration. This is for, yeah, that is it. Yes. Then I'm having the ones for this one, selling and distribution. No, sorry. This is not here. This is for here. This is 10,09006. And on the cost of sales, we have 55514, 55514. The distribution costs we have in 10,09006. The administration cost we are having 10,20795, and the finance costs we are seeing 2,000. The finance costs we are seeing 2,000. So these are the totals we are going to take in our income statements. So allow me to wrap up this and finalize by doing our income statement. And we all know how the format, we know the format of how this income statement should look like, since we've got a brief presentation of how it should be presented. We've got a brief of how it should be presented. So we shall say zipper. Is it zipper? Yes, zipper. Zipper Limited is statement of of profit, loss, and other comprehensive income. Another incomes for the year ended or for the year ending. Which year did they give us? Which year did they give us? Hopefully you are following. For the year ended 30th June 2013. Sorry, 2012. 2012. So let's quickly go through this and call it day. So we are having the details. We have the note, and you can call this one the amount. So under details, we are having the revenue. And how much revenue are we having? We are having a revenue of 98,350. So I bring it and I put it here. 98 through what? 50. We together. 98,350. Then I less cost of sales. And under the cost of sales, we are having 5,514. So that is, so assuming this one is not 1, this one is not 2. 5,514. 5,514. 5,514. So when I less this from this, I will get what we are calling the gross what? The gross profit. I am getting the gross what? The gross profit. And when you press your calculator, you will get your gross profit as 42,836. That is our gross profit. Then we said when after getting the gross profit we less operating what? Expenses. And under the operating expenses, we are having the selling and distribution. And under the selling and distribution, we are having which figure? Under selling and distribution, we are having 10,906. 10,906. Then we have the administration costs. Of how much? I'm seeing a 20795. 20795. Then I have the finance costs. And the finance costs, I'm having 2,000. So when I get this minus this, I will get what we are calling the profit before what? Profit before tax. Tax. And the profit before tax, when you get this, I am seeing a figure of 9135. 9135. Allow me to rub off this and I continue from there. It's because of space that I have to utilize the other space. So, hopefully you don't mind, and hopefully you are all following together. Hopefully you are following together. So, after obtaining the profit before tax, I now bring in the tax issue. In our question, I'm seeing a 30% tax. So I less tax of how much? 30%. Now I told you that the tax is put or is placed on the profits that made. And now the profits we have made is this. So to obtain the tax, so our taxation, let me work it from here. Taxation, we have been told 30%, that is 30 out of 100 times the profit that you have made. The profit you have made is 9135. Is it? 9135. So when I get the 30% of this tax, I am seeing something of 2. I'm seeing a 2740.5. 27, I get 2740.5. 2740.5. So that tax, I am lessing it off on our profit before tax. That is 2740.5. So the profit before tax is how much we got. We got 9135. So when I less this from this, I get our profits after tax. And how much are we getting? I urge you to help me get for me the tax, to get for me the profit after tax, and make sure you comment. I will mark you very well. Thank you for following with me, and I want to wish you the best. Make sure you come back always and watch more videos concerning all course units that we are covering. Thank you.